The first 12 months in the field of speculation are the most critical. This is the period during which the foundation for a successful, lifelong career is laid, or, as is more often the case, the period in which a trading account is destroyed and the ambition to succeed is permanently extinguished. Success during this formative year is not determined by the discovery of a secret indicator or a complex algorithm. It is determined by the strict and unwavering adherence to a set of sound, foundational, and inviolable rules of conduct. Richard D. Wyckoff, through his decades of practical experience, formulated these core principles. Today, we will present them as 12 golden rules, one for each month of your first year, which will serve as your comprehensive roadmap from the position of a novice to that of a developing professional. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well. For the first month, you will adhere to rule number 1. Your primary objective is survival, not profit. The single greatest error of the novice trader is that he enters the market with the immediate and overriding goal of making money. This is a fatal flaw in his reasoning. The market does not exist to provide you with a steady income, especially not in your first month of operation. The market is a harsh and unforgiving environment, and its first lesson is almost always one of loss. Statistical evidence from brokerage firms has consistently shown that the vast majority, often cited as high as 90%, of new traders lose a significant portion, if not all, of their starting capital within their first few months. This initial period of loss is often referred to as paying one's tuition to the market. While some tuition is unavoidable, the amount can be drastically minimized by a fundamental shift in perspective. During your first month, you must consciously and deliberately subordinate the goal of making a profit to the far more important goal of preserving your capital. Your job is not to win the war in the first month. It is to ensure that you survive long enough to fight another day. This requires an immediate and rigorous application of the most basic principles of risk management. The most important of these is the 1% risk rule. This rule states that you should never, under any circumstances, risk more than 1% of your total trading capital on a single speculative idea. If your trading account is $10,000, your maximum acceptable loss on any single trade is $100. This is not a suggestion, it is a law. This rule forces you to confront the mathematical reality of risk before you are ever allowed to indulge in the emotional fantasy of reward. It requires you to calculate your position size based not on how much you hope to make, but on how much you are willing to lose. You must first determine your logical entry point and your logical stop-loss point. The distance between these 2 points is your per-share risk. You then divide your maximum acceptable dollar loss, $100 in our example, by this per-share risk to determine the exact number of shares you are permitted to trade. This non-negotiable mathematical process protects you from your own worst impulses. It makes it mathematically impossible to destroy your account with 1 or 2 bad trades. It ensures your survival, which is the only objective that matters in your first month. For the second month, you will adhere to rule number 2. You must master 1 strategy, not dabble in 10. The novice trader, after experiencing his initial losses, often falls into a second trap: the endless and fruitless search for a perfect trading system. He will read a book on one method, try it for a week, and after a few losing trades, he will discard it in favor of a new, more exciting indicator he discovered online. He jumps from candlestick patterns to moving average crossovers, from Elliott wave theory to Gann angles, never remaining with any single method long enough to achieve a true, deep understanding of its principles. This is the fatal habit of system hopping. Success in speculation, as in any professional endeavor, comes from the deep mastery of one coherent and logical method, not from a superficial acquaintance with many. This channel, as you know, is dedicated to the comprehensive study of the Richard Wyckoff method of market analysis. The second golden rule, therefore, requires that you commit yourself fully to the study and application of this single, time-tested approach. For this month, your task is to put away all other books, to ignore all other indicators, and to focus your entire intellectual energy on understanding the core principles of the Wyckoff method. This means you must dedicate yourself to the study of reading the chart by its own action. You must learn to analyze the relationship between price and volume. You must begin to understand the great market cycles of accumulation and distribution. You must study the specific evidence-based events that signal a change in the market's behavior, such as a selling climax or a sign of strength. This deep and focused immersion in a single logical framework is infinitely more valuable than a scattered collection of unrelated indicators. A professional speculator is a specialist, not a generalist. He has one set of well-honed tools that he knows how to use with masterful precision. Your second month is the time to begin the long and rewarding process of forging those tools. For the third month, you will adhere to rule number 3. The market is your only teacher. The tape is its only language. Now that you have committed to a single method of analysis, you must learn to apply it using only the purest and most reliable source of information. The modern financial world is a cacophony of noise. You are bombarded from all sides with news headlines, expert opinions, analyst upgrades and downgrades, economic forecasts, and the endless chatter of social media. The novice trader consumes this information voraciously, believing that it will give him an edge. This is a profound mistake. The vast majority of this external information is, at best, a distraction, and at worst a form of deliberate and sophisticated manipulation. Richard Wyckoff taught that the only source of truth about the market's intentions is the market's own action. This action is recorded second by second on what he referred to as the tape. In our modern context, the tape is simply the price chart and its corresponding volume data. This is the only language the market speaks, and it is the only language you must learn to understand. The price and volume action represents the final, amalgamated result of every piece of information, every opinion, every hope, and every fear of every participant in the market. The story that the tape tells is the true story. Your work in the third month, therefore, is to train yourself to listen only to this story and to ignore all other sources of noise. This means you must practice the daily, disciplined art of reading the charts. You must spend time every single evening analyzing the price and volume action of the major market averages and of the leading stocks. You must learn to interpret the relationship between the effort, as represented by the volume, and the result, as represented by the price spread. You must ask yourself, day by day, what is the tape telling me about the balance between supply and demand? This is the only question that matters. To listen to an analyst's opinion on television while the tape itself is telling you the opposite story is an act of self-sabotage. Your third month is about cultivating the intellectual independence to trust the evidence of the chart above all else. For the fourth month, you will adhere to rule number 4. You must never enter a trade without a predefined and written plan. Trading is not a reactive activity. It is the deliberate execution of a well-formulated plan. To enter the market on an impulse without a clear and logical reason for your action is not speculation. It is pure gambling. By the fourth month of your development, every single commitment of your capital must be preceded by the creation of a simple but non-negotiable trading plan. This plan must be written down. The physical act of writing clarifies your thought process and enforces a minimum standard of discipline. The plan for any single trade must, at a minimum, contain 4 essential components. First, you must articulate your precise reason for entry. This cannot be a vague feeling or a hopeful guess. It must be a clear, evidence-based statement derived from your Wyckoffian analysis. For example, the general market is in a confirmed uptrend. This stock is a leader in a strong group. It has completed a 6-month accumulation base, has successfully executed a shakeout, and has just shown a clear sign of strength. I am entering based on this evidence. Second, you must define your exact entry level. This is the specific price at which you intend to act. As we will study in later months, this is ideally not the breakout itself, but a low-volume test at a last point of support. Third, you must define your logical stop-loss point. This is the price at which your initial thesis is proven incorrect. It is your predetermined exit point in the event of failure. Fourth, you must establish a preliminary price objective. This is a logical estimate of the potential for the trade, often derived from a point-and-figure chart analysis of the cause that has been built. If you cannot clearly and concisely articulate these 4 points on a piece of paper before you place an order, you do not have the right to risk your capital on the trade. This rule is absolute. It is the final barrier that separates the impulsive actions of the amateur from the deliberate professional operations of the developing speculator. Having survived the first 4 months of your trading education, you have now successfully laid the critical foundation for a professional career. You have learned to prioritize capital preservation above all else. You have committed to the deep study of a single, logical method of analysis. You have learned to trust the verdict of the tape over the noise of outside opinions. And you have instilled the discipline of creating a written plan before every single trade. You have built your defensive walls. The next 4 months of your development are dedicated to building your professional process. We now transition from a mindset of pure survival to the methodical and disciplined process of identifying and executing high-probability trading opportunities. For the 5th month, you will adhere to rule number 5. You must trade only the clearest and most well-defined setups. The greatest single strategic error that plagues the developing trader is the belief that he must be active every single day. He feels a constant pressure to be in the market, fearing that any day without a trade is a day of missed opportunity. This leads to the fatal habit of overtrading, the act of forcing trades on mediocre, ambiguous, and low-probability setups simply to satisfy an internal craving for action. This is the path to the slow and certain erosion of capital. Your task in the 5th month is to declare war on this impulse. You must consciously and deliberately abandon the idea of frequent trading and replace it with the professional philosophy of extreme selectivity. This is the concept we refer to as the pursuit of one good trade. You must come to the profound understanding that one perfectly selected, meticulously planned, and flawlessly executed trade per month is infinitely superior to 10, 20, or 50 impulsive and ill-conceived trades. The professional speculator is not a day laborer who gets paid for his time. He is a patient hunter who is paid only for his judgment and his precision. This requires you to establish an exacting standard for what constitutes an actionable opportunity. An A-class setup, the only type of setup a professional considers, is one in which the full and complete body of technical evidence is present, clear, and unambiguous. It is a setup that perfectly matches the theoretical models of accumulation that we study. It must show a clear selling climax, a prolonged period of absorption with the correct volume signatures, a definitive final test in the form of a spring or shakeout, and a powerful sign of strength. If any one of these pieces of evidence is missing, weak, or unclear, the setup is, by definition, not A-class, and it must be discarded without a second thought. Your job is not to find a reason to trade. Your job is to find a setup so perfect that it leaves you with no reason not to trade. For the 6th month, you will adhere to rule number 6. You must first and always determine the trend of the general market. We introduced this concept as a foundational principle, but in the 6th month of your development, it must become an inviolable and non-negotiable part of your daily analytical routine. No individual stock, no matter how compelling its individual chart pattern, can be considered in a vacuum. It exists within a broader market environment, and the trend of that environment is the single most powerful factor that will influence its destiny. Your daily work must now begin, without exception, with a thorough and dispassionate analysis of the major market averages. You must analyze their price and volume action with the same rigor that you apply to an individual stock. Your objective is to determine which of the four market phases, accumulation, markup, distribution, or markdown, is currently in control of the overall market. This analysis serves as your primary strategic filter. A good trade on the long side requires a supportive market environment. Therefore, if your analysis of the general market indicates that it is in a state of confirmed distribution, or even worse, an active markdown phase, your search for new long positions must be suspended entirely. This single rule, when applied with unwavering discipline, will automatically filter out at least 50% of all potential losing trades. It is the great wall of defense that protects you from attempting to swim against a powerful and unforgiving tide. The amateur looks for the one stock that might go up in a falling market. The professional understands that the probabilities are overwhelmingly against such an endeavor, and he has the discipline to simply stand aside, preserving his capital and his mental energy until the broader strategic environment becomes favorable once again. For the 7th month, you will adhere to rule number 7. You must identify and trade only the market leaders. After you have confirmed that the general market is in a constructive uptrend, your next task is to direct your capital to the point of maximum efficiency. In the stock market, this means concentrating your commitments exclusively in the stocks that are demonstrating the greatest relative strength. You must hunt for the leaders and ruthlessly ignore the laggards. The composite operator, our conceptual model for the smart, informed money that drives market trends, does not spread his immense capital thinly across hundreds of mediocre stocks. He concentrates his buying power in a select handful of securities that he believes possess the greatest potential for a rapid and sustained advance. These stocks become the market leaders. Our job as scientific speculators is to identify the footprints of his activity and to align our own, smaller campaigns with his. The process of identifying these leaders is a practical and methodical one. It is a process of comparative analysis. You must compare the price chart of an individual stock to the chart of its industry group and to the chart of the general market. A true leader will exhibit clear and quantifiable outperformance. During rallies, it will rise faster and further than the averages. During market corrections, it will fall less or hold its ground more stubbornly. This superior price action is not an accident. It is the direct evidence of persistent and aggressive professional accumulation. Leaders are not only more profitable, but they are also safer. Their relative strength is a sign that they are being professionally sponsored and supported. Laggards, conversely, are stocks that are being neglected or actively distributed by the composite operator. To buy a laggard is to make a bet that the weakest player on the field will suddenly become the strongest. This is not sound speculation. In your 7th month, you must train yourself to think like a professional portfolio manager whose sole job is to place capital where it will work the hardest. This always means the market leaders. For the 8th month, you will adhere to rule number 8. You must allow the market to confirm your judgment before you act. The amateur trader is a predictor. He attempts to guess where the market is going and to act before the move begins, hoping to be the first one in. This is an operation based on ego and hope. The professional speculator is not a predictor. He is a detective. He patiently waits for the market to present a full and complete body of evidence, and he acts only after that evidence has confirmed his analysis. This rule is the essence of patience at the point of entry. In our previous studies, we have identified the sequence of events that constitutes a complete accumulation. The final event in this sequence is the sign of strength, the decisive breakout from the trading range. The amateur, seeing this powerful move, is immediately seized by the fear of missing out and chases the price higher. This is a critical error. The professional sees the sign of strength not as a signal to buy, but as the final piece of evidence that confirms his bullish thesis. He has seen the stopping action, the absorption, and the final test. Now he has seen the show of intent. His case is complete, but he still does not act. He now waits for the market to provide him with a low-risk point of entry. He waits for the last point of support. This is the first natural minor pullback or reaction that occurs after the initial sign of strength. It is a moment of quiet, a test of the breakout. The professional's final act of analysis is to judge the character of this test. He must demand to see that it occurs on light, diminishing volume, which is the final, conclusive proof that the supply is exhausted. This is the professional entry point. It is a moment of calm, of logic, and of clearly defined risk. The discipline to forego the excitement of the initial breakout and to wait patiently for this final logical confirmation is one of the most important distinctions between the professional and the amateur. Wyckoff's method provides a masterclass in reading the internal action of the market to build a trading plan. It's a deep forensic analysis. However, it is essential to recognize that other market titans had entirely different yet equally disciplined daily routines. Bernard Baruch, for example, based his decisions on a deep understanding of geopolitical events and fundamental economic shifts. Nicholas Darvas used his mechanical box theory, a system that ignored almost everything except price action. Richard Dennis and his turtles were given a simple set of rules, a complete trading plan they had to follow mechanically. To provide you with a comprehensive education on these diverse but equally potent methodologies, we created our new channel, Trading Insights. It is dedicated to the practical strategies and success stories of these legendary speculators. To see how different masters built their success, we invite you to subscribe and watch. The link is in the description. You have now successfully navigated the first 8 months of your professional development. The foundational principles of survival have been instilled, and a rigorous evidence-based process for identifying high-probability opportunities has been established. You have learned how to think strategically, how to select your targets with precision, and how to wait with patience for the market to confirm your judgment. The final 4 months of your inaugural year are dedicated to the most advanced and most important subject of all, the development of sound professional judgment and the forging of unshakable psychological fortitude. This is the transition from a student who follows rules to a professional who understands the principles behind them. For the 9th month, you will adhere to rule number 9. You must manage the trade, not the money. Once a position has been taken according to a sound, well-reasoned plan, a new and dangerous enemy enters the field: the profit and loss statement. The constant, flickering changes in the value of your open position are a powerful source of emotional distraction. An amateur trader will spend his day watching his floating profit and loss, his emotional state rising and falling with every minor tick of the price. If the profit grows, he becomes euphoric and greedy. If it shrinks, he becomes fearful and anxious. His subsequent decisions, to hold, to sell, or to add to the position, are therefore based not on the objective action of the market, but on his emotional reaction to the fluctuating value of his account. This is a fatal error. Your task in the 9th month is to learn to completely divorce your trade management decisions from the influence of your open profit or loss. Your decisions must be based solely and exclusively on the unfolding evidence on the price chart. The market itself, through its own action, will tell you when to hold a position and when to exit it. To achieve this state of professional detachment, you must adopt a mechanical and unemotional method for managing your winning trades. The most effective tool for this is the trailing stop. As we have discussed in previous studies, a trailing stop is a protective stop-loss order that is methodically moved higher as the trend progresses in your favor. The correct Wyckoffian application is to, after each significant advance and subsequent minor correction, raise your stop-loss order to a point just below the low of that most recent correction. This simple logical technique accomplishes something profound. It automates the process of letting your profits run. It removes the emotional burden of having to decide day after day whether you should take your profit or hold on for more. The decision is delegated to the market itself. Your job is no longer to guess where the top might be. Your job is simply to follow your rule and trail the stop. The position is held, and the profits are allowed to accumulate until the market's own uptrending character finally changes, a significant correction low is violated, and your stop is logically executed. This mechanical approach ensures that you are managing the trade based on its actual technical structure, not on your emotional reaction to the money involved. For the 10th month, you will adhere to rule number 10. You must study your losses. They are your most valuable tuition. No speculator, no matter how experienced or brilliant, is correct 100% of the time. Losses are an inevitable, unavoidable, and necessary part of the business of speculation. The amateur trader fears his losses and attempts to forget them as quickly as possible. The professional, by contrast, embraces his losses. He understands that every losing trade, when correctly analyzed, is a priceless lesson for which he has already paid. His task is to extract the maximum possible educational value from that payment. The critical tool for this work is a detailed and diligently maintained trading journal. In your 10th month, the keeping of this journal must become an inviolable part of your daily routine. For every single trade you take, win or lose, you must record a specific set of information. This includes a chart of the setup before your entry, a clear and concise written statement of your evidence-based reason for entering the trade, your full trading plan including your entry point, your initial stop loss, and your price objective. After the trade is closed, you must record the result. Most importantly, for every losing trade, you must conduct a thorough and brutally honest post-mortem analysis. You must ask yourself a series of critical questions. Did I violate one of my rules? Did I fail to assess the general market correctly? Did I chase a price instead of waiting for a proper entry? Was my analysis of the volume and spread incorrect? Did I act on an impulse or an emotion? You must identify the precise point of failure in your process. This regular and systematic review of your errors is the single fastest path to eliminating your operational weaknesses. Your losing trades, when subjected to this kind of rigorous scientific analysis, will cease to be painful events and will instead become your most valuable and effective teachers. For the 11th month, you will adhere to rule number 11. You must recognize that patience is your ultimate weapon. Throughout this year-long journey, we have touched upon the importance of patience at various stages. In this, the penultimate month of your foundational year, you must synthesize these concepts into a single, unified understanding. Patience is not a single skill. It is a multifaceted discipline that must be applied at every single stage of a professional operation. Your success will ultimately be a direct function of the degree to which you can master these three forms of professional patience. First, there is the strategic patience required to wait for a true A-class setup to appear. This is the discipline to sit in cash for weeks, or even months if necessary, filtering through hundreds of mediocre opportunities and refusing to act until that one single candidate appears that meets every single one of your exacting criteria. This is the patience of the hunter, who can wait motionlessly for days for the perfect target to present itself. Second, there is the tactical patience required to wait for the correct low-risk entry point. This is the discipline, after having identified a perfect setup, to wait for the market to come to you. It is the patience to watch the initial, exciting breakout happen without you, and to calmly await the quiet, low-volume pullback to a last point of support. This is the patience of the sniper, who waits for the single perfect moment to pull the trigger. Third, there is the operational patience required to remain in a winning position and to let it grow to its full potential. This is the discipline to sit through the natural minor corrections that punctuate every major trend, to trust your analysis, and to manage your position with a mechanical trailing stop rather than with day-to-day emotion. This is the patience of the general, who has the fortitude to see a long and successful campaign through to its logical conclusion. At every stage of the process, from initial selection to final exit, patience is the critical factor that maximizes your probability of success and minimizes your exposure to unnecessary risk. For the 12th month, you will adhere to rule number 12. You must begin to evolve from a technician to a strategist. The final goal of your first year of study and practice is to begin to synthesize all of the individual rules and concepts you have learned into a single, cohesive, and holistic understanding of market operations. In the beginning, you learn to identify individual chart patterns and signals. By the end of your first year, you must begin to see the bigger picture. You must learn to think not in terms of individual trades, but in terms of complete campaigns. This is the final and most important evolution in a speculator's mindset. It is the ability to see the entire logical narrative of the market as it unfolds over many months. This means you should now be able to view a chart and see the full story. The great markdown phase, the climactic selling climax that brings it to an end, the long and patient process of accumulation where the composite operator builds his cause, the final shakeout, the initial sign of strength, the low-risk entry at the last point of support, the long and profitable markup phase, and finally the first warning signs of a new campaign of distribution at the top. You should begin to integrate the use of the point and figure chart to project the logical price objectives for your campaigns. You should be able to see the entire process as a single unified whole. This is the transition from a technician who simply follows a set of mechanical rules to a strategist who understands the underlying logic, the why behind those rules. This deep, intuitive understanding of the market's great cycles, of the composite operator's motives, and of the mass psychology that drives prices, is the final and highest achievement of a Wyckoffian education. It is the foundation upon which a long and truly successful career is built. This video has given you a 12-month roadmap. But to navigate this challenging journey, you need more than just rules. You need deep, foundational wisdom. Richard Wyckoff's essential work, How I Trade and Invest in Stocks and Bonds, provides that wisdom. This book is not a list of patterns. It is a course in developing professional market judgment. In it, Wyckoff shares his own stories, his early mistakes, his profitable campaigns, and the hard-won principles that guided him for decades. You will learn the why behind the rules we've discussed, directly from the master himself. If you are serious about building a lifelong career in the markets, this book is your indispensable guide to thinking like a true professional. In our conclusion, we have laid out 12 golden rules that, when followed with discipline, will guide you through your first and most critical year of trading. They are a logical and progressive path of development, beginning with the absolute necessity of survival, moving through the construction of a sound professional process, and culminating in the development of true market judgment. Your first year in the market will define your entire future career. Its objective is not to get rich, but to lay an unbreakable foundation of sound principles and professional habits. By strictly adhering to these 12 rules, you will not only survive your first year, but you will emerge from it with the skills, the discipline, and the mindset that will serve you for a lifetime of profitable speculation.